Listen closely, because what you're about to read isn't being discussed on your evening news broadcast. While commentators debate surface-level political theater and analysts recite sanitized talking points about democracy and security operations, something far more significant is unfolding beneath the surface of global markets. The events of early January 2026 represent a fundamental shift in how the world acquires and secures the resources that power modern civilization. This isn't about ideology or spreading freedom. This is about the raw materials that determine which nations thrive and which collapse in the coming decades. Consider what happened in the pre-dawn hours of January 3rd in the capital of Venezuela. Precision strikes illuminated the sky over a major military installation, while special operations forces executed what can only be described as a decapitation mission. The operation targeted the highest levels of government, extracting leadership and transporting them to naval assets positioned offshore. The official explanation centered on criminal prosecution and restoring democratic governance. But timing reveals truth more accurately than press releases ever could. Why execute such a high-risk operation at this precise moment in history? The answer lies not in the rhetoric of liberation, but in the cold calculus of resource mathematics. Venezuela possesses energy reserves that dwarf most nations, but production had already declined significantly due to years of economic mismanagement. On paper, removing those barrels from global markets shouldn't trigger systemic crisis. Yet paper calculations ignore a crucial detail about quality and compatibility. The heavy crude produced in Venezuelan fields isn't interchangeable with the light, sweet varieties extracted elsewhere. Massive refining complexes along the Gulf Coast and in China's industrial heartland are specifically engineered to process this heavier grade. These multi-billion-dollar facilities cannot simply switch feedstocks without catastrophic operational disruptions. Without access to this specific crude, the diesel markets that move goods across continents face immediate pressure. This creates leverage that transcends simple supply and demand, but focusing exclusively on energy misses the deeper strategic target. The true prize lies in the mineral wealth concentrated in a vast mining region spanning over 100,000 square kilometers. This territory contains deposits of gold, diamonds, industrial minerals, and critically, substantial silver reserves. Under the previous regime, this area functioned as an unregulated shadow economy, where precious metals flowed through unofficial channels to international markets, bypassing sanctions and fueling networks that operated beyond legal oversight. The military operation didn't just remove political leadership, it severed the logistics that allowed this metal to reach global buyers. In doing so, it created an immediate supply disruption that markets are only beginning to comprehend. The significance of this disruption becomes clear when you understand what happened just 48 hours before the first aircraft appeared over Venezuelan territory. On the first day of January 2026, China implemented a comprehensive export licensing system for silver that fundamentally altered global supply chains. The new regulations restrict exports to only the largest state-approved firms, with substantial production capacity and financing. This wasn't a minor policy adjustment or a revenue-generating tariff. This was a strategic chokehold on approximately 121 million ounces of annual supply. China doesn't just mine silver. They dominate the refining sector and control production of critical silver-based materials essential for solar panel manufacturing. By restricting these exports, Beijing signaled that silver has been reclassified from a commodity to a strategic material vital for national industrial policy. These two shocks, the regulatory barrier from the east and the kinetic operation in the south, converged to create unprecedented pressure on a market that was already structurally imbalanced. For years, silver traded primarily as the forgotten cousin of gold, moving predictably in response to interest rates and inflation expectations. But in the opening days of 2026, something fundamental changed. Silver began trading as a critical strategic asset, essential for both industrial production and monetary survival. The decoupling from its historical relationship with gold signals a complete re-rating of the metal's role in the global economy. Market reactions revealed the depth of this transformation. When trading resumed after the weekend operation, crude oil prices moved higher but remained within predictable ranges. Silver, however, surged toward $80 per ounce, building on momentum that had already pushed prices to record territory in late December as traders anticipated the Chinese export restrictions. The psychology driving this movement differs fundamentally from typical commodity speculation. Geopolitical crises of this magnitude trigger a phenomenon where investors and industrial buyers stop trusting paper promises and demand physical delivery. They fear counterparty risk and the weaponization of clearing systems themselves. When you see military forces seizing sovereign leadership and securing resource-rich territory, confidence in abstract financial claims evaporates rapidly. Within Venezuela itself, the economic consequences manifested immediately. The national currency, already weak, experienced terminal collapse on black markets where actual transactions occur. Exchange rates gapped violently within hours of the operation, creating an environment where the official banking system became irrelevant for survival purposes. In this vacuum, pricing for basic necessities reverted to the oldest form of economic exchange. Reports from the capital describe transactions being quoted exclusively in US dollars or in grams of silver. This isn't theoretical economics from a textbook. This is the ground reality when fiat systems disintegrate under the pressure of geopolitical upheaval. The phenomenon emerging in Venezuelan streets provides a preview of broader dynamics now entering global markets. Silver possesses unique characteristics that make it valuable precisely when traditional systems fail. It's universally recognized, impossible to counterfeit, requires no infrastructure to verify, and holds value across all political boundaries. When power grids fail and banking networks freeze, physical precious metals become the only reliable medium of exchange. This survival valuation creates pricing dynamics that differ dramatically from the numbers displayed on financial terminals. While global spot prices might indicate $75 per ounce, actual transactions in conflict zones can occur at substantial premiums, sometimes reaching $100 or more in real-world exchanges for essential goods. This premium reflects not speculation, but utility, the ability to secure food, fuel, or safe passage when everything else has failed. Paradoxically, these same conditions create distressed selling where desperate families liquidate heirlooms at 50% discounts just to obtain immediate necessities from buyers with hard currency. This divergence, where silver simultaneously represents both the highest value and deepest discount depending on circumstances, illustrates the commodity dislocation now spreading beyond Venezuela's borders. The price you see on a screen and the price you pay in reality are becoming two entirely different numbers. Understanding this dislocation requires examining the technical structure underlying silver markets. The primary exchange, where silver futures trade, has operated for decades on a system where paper contracts vastly outnumber physical metal available for delivery. By late 2025, this imbalance had reached extraordinary proportions. For every single ounce of registered silver actually sitting in approved vaults ready for delivery, there existed over 350 paper claims on that same ounce. In stable conditions, this system functions through continuous contract rollovers and cash settlements, but geopolitical shocks destroy the assumptions enabling this equilibrium. When investors lose confidence in the system itself, they stand for physical delivery rather than accepting cash equivalent. This creates a cascading pressure on inventories that were never designed to satisfy simultaneous delivery demands. Compounding this vulnerability, physical inventories in registered vaults have declined 70% since 2020. This wasn't a temporary drawdown, but a multi-year industrial drain that hollowed out the buffer protecting the system from delivery squeezes. The sudden spike in delivery requests triggered by geopolitical uncertainty has collided with these depleted reserves, creating the conditions for a classic short squeeze. But this isn't driven by retail speculation or coordinated social media campaigns. This is institutional panic, manufacturers and sovereign entities demanding physical metal because they can no longer trust the logistics and legal frameworks they've relied upon for decades. The technical structure of this breakout exhibits characteristics that distinguish it from previous cycles. Historically, when the US dollar strengthens, commodities priced in dollars tend to decline. This dollar wrecking ball effect appeared clearly during previous geopolitical crises, but 2026 presents a different dynamic. Silver is rising alongside dollar strength, a rare and ominous signal. This indicates that fear in the market transcends normal inflation and interest rate concerns. Investors are pricing in what analysts call empire risk, the possibility that any asset held within dollar-based systems could be frozen, seized, or devalued through policy changes that occur faster than markets can react. When military force is used to secure resource territories, every sovereign actor realizes their holdings are potentially vulnerable. This realization is accelerating a trend already visible in central bank behavior. Non-aligned nations, particularly those in emerging economic blocs, are watching these developments with extreme caution. From their perspective, if a powerful nation can designate a sovereign government as criminal and use that designation to justify seizing energy and mineral reserves, then no asset held in that nation's financial system is truly secure. This is driving aggressive accumulation of physical precious metals and the repatriation of reserves from vaults in traditional financial centers. Central banks are no longer comfortable leaving their strategic reserves in facilities they don't directly control. They're bringing metal home, further draining the available float of physical supply in Western markets. Gold has responded to these dynamics by breaking through all-time price records, crossing $4,400 per ounce as markets opened following the Venezuelan operation. The debasement trade is accelerating as investors anticipate massive debt expansion to finance military operations and subsequent reconstruction efforts. But silver is outperforming on a relative basis because it faces dual demand pressures. Unlike gold, which is primarily held as a store of value, silver is being consumed at record rates by industrial applications that cannot be postponed or substituted. The transition to renewable energy and electric transportation isn't optional for nations pursuing energy security and climate commitments. These technologies require silver in quantities that strain available supply even under normal conditions. Solar panels depend on silver paste for electrical conductivity. Electric vehicle components utilize silver in power electronics and battery systems. Advanced military electronics incorporate silver throughout their designs. There's no viable substitute that matches silver's unique combination of electrical conductivity, thermal properties, and reliability. When China implemented export controls, they effectively declared this reality to the world. Silver is no longer a precious metal used primarily for coins and jewelry. It has been re-rated as a technology metal as critical as semiconductors or rare earth elements for modern industrial civilization. This creates what specialists call an industrial floor, a price level below which the metal cannot fall because industrial buyers will simply purchase everything available rather than risk production shutdowns. When you add a geopolitical war premium on top of this industrial support, you create extraordinary price resilience. Even if kinetic conflicts in the Caribbean were to de-escalate tomorrow, the structural deficit caused by Chinese export restrictions remains permanent. Any price dips are likely to be met by waves of industrial buying from manufacturers terrified of their assembly lines going dark for lack of essential materials. The comparison to a speculative bubble from decades past illuminates why the cycle differs fundamentally. In 1980, wealthy speculators attempted to corner the silver market through leveraged futures positions, driving prices to extraordinary heights before the scheme collapsed. That was pure financial manipulation with no industrial foundation. The 2026 price movement is built on opposite fundamentals. The shortage is real, driven by voracious industrial consumption in the East and the sudden geopolitical lockup of Western Hemisphere resources. This isn't speculation. This is manufacturers and nations scrambling to secure physical metal essential for their technological and industrial survival. The military operation in Venezuela is predicated on transitioning governance to opposition forces with plans for massive privatization of the mining sector. The goal is to professionalize extraction, dismantle criminal networks, and bring in major Western mining corporations to develop resources according to international standards. This sounds reasonable on paper, but implementation will require years, not months. The infrastructure in the mining territories has been degraded by decades of neglect and predatory practices. Legal liabilities from previous expropriations must be resolved before publicly traded companies will invest capital. Environmental remediation alone represents a multi-year undertaking. In the short and medium term, Venezuelan silver production is effectively offline. This represents a multi-year supply-side reduction coinciding perfectly with Chinese export restrictions. Market participants are beginning to recognize these realities as the shock phase of early 2026 drives prices toward retesting all-time highs. As the year progresses, even if new governance stabilizes the situation and war premiums begin to fade, silver will not return to previous price levels. The industrial floor has been permanently elevated by structural deficits that cannot be resolved quickly. Chinese solar demand alone, as they pursue their renewable energy targets, creates insatiable appetite that cannot be satisfied by existing supply channels. Any new production from a professionalized Venezuelan mining sector is minimum 3 to 5 years away, and that assumes perfect execution, with no delays or complications. Looking further ahead toward 2030, the trajectory becomes even more compelling. The geological reality facing the mining industry is that high-grade silver deposits are increasingly rare. Ore grades are declining globally as the easiest deposits have been exploited. There has been chronic underinvestment in new primary silver mines for over a decade, because low prices discouraged capital allocation to exploration and development. Bringing a new mine from discovery to production requires 7 to 10 years under optimal conditions. This means the supply deficit is structural and permanent. We are looking at a secular bull market where $100 silver is not optimistic projection, but mathematical inevitability, as the metal is re-rated according to its true strategic importance. For the people living through economic collapse in Venezuela, the path forward remains difficult. Eventually, as the economy stabilizes under new administration and dollarization takes hold, the extreme premiums and discounts will moderate as local prices converge with global markets. But for global investors and manufacturers, the lessons of early January 2026 are unambiguous. The military intervention represents a watershed moment, a kinetic manifestation of the resource scramble that defines this century. By moving to secure the Western Hemisphere's largest energy and mineral reserves through force, a new precedent has been established that other nations are studying carefully. The silver market has been struck by a perfect storm combining regulatory supply shock from the east and geopolitical demand shock from the south. The result is paradigm shift, where silver is no longer simply a metal to be bought and sold on speculation. It has become a barometer measuring global instability, industrial necessity, and the death of trust in financial systems that operated smoothly for decades. Whether it's the silver flake held in the hand of a merchant in a crisis zone, or the futures contract traded on a major exchange, the underlying story is identical. In a world of fracturing trust and kinetic resource acquisition, tangible assets represent the only reliable sanctuary. The era of cheap, abundant resources extracted under stable political conditions and transported through reliable logistics networks is ending. We are entering a period where access to critical materials will be determined increasingly by military positioning, strategic alliances, and willingness to use force when economic mechanisms fail. The events of January 2026 aren't isolated incidents, but the opening moves in a longer game that will define geopolitical relationships for the remainder of this century. Nations that secure reliable access to strategic materials will maintain industrial capacity and living standards. Nations that fail to secure these resources will face difficult choices about which industries to maintain and which to abandon. The repricing of silver from commodity to strategic asset represents one visible manifestation of this broader transformation. The mathematical reality of 350 paper claims competing for every physical ounce cannot be sustained when trust evaporates and delivery demands surge. The hollowed-out vaults cannot satisfy simultaneous claims when the game of musical chairs ends abruptly. The divergence between screen prices and ground reality will continue widening as market participants realize that possession of physical metal matters more than abstract financial claims. This is why silver is being accumulated by central banks, industrial giants, and individual investors who understand that the rules of the game have fundamentally changed. We are witnessing the most significant repricing of strategic assets in modern history, driven not by monetary policy or business cycles, but by the raw physics of supply and demand in a world where cooperation is being replaced by competition and trust is being replaced by force. The window for positioning ahead of this realization is narrowing as more participants recognize these dynamics. The train has left the station, accelerating toward a destination where critical materials trade at valuations reflecting their true indispensability rather than the artificially suppressed prices of the past decades. Those who understand this transformation and act accordingly will navigate the turbulent period ahead with resources that retain value, regardless of political upheaval or currency debasement. Those who remain anchored to old assumptions about how markets function and how resources are allocated will discover too late that the world they understood no longer exists. The age of strategic resource competition has arrived, and silver stands at the center of this transformation as both witness and participant in the most significant economic restructuring of our lifetimes.